Hello students, and welcome to this video on the presentation of financial statements, which is IAS 1 International Accounting Standard number 1. As always, I would like for us to start with a quote of inspiration. And Nelson Mandela said, "There is no passion to be found in playing small." Just something for you to remember. Then we need to quickly look at our study outcomes per study guide. So you need to apply the objectives and components of financial statements. You need to discuss the general features, structure, and content of financial statements, and you need to present financial statements in accordance with IFRS, which is the International Financial Reporting Standards. An introduction. IAS 1 is the accounting standard that regulates the presentation of financial statements. So IAS 1 was set up because one cannot set up financial statements just as you wish. So there are certain rules that should be applied to ensure that there's uniformity among entities' financial information. What is included in a set of financial statements? We always talk about financial statements, but what do we refer to? So we look at a statement of financial position. We have a statement of profit and loss and other comprehensive income, a statement of changes in equity, a statement of cash flow, accounting notes, accounting policies, and extra explanatory information. We have a director's report, and we also have an auditor's report. So that's what's included in a set of financial statements. Then, who uses accounting information? So accounting information is used by investors because they supply capital and they want to quantify risk. So they want to know, will I earn a return or will I lose money if I provide capital to this entity? Then also employees, they require information about profitability, growth and benefits to know whether they will be employed for a long time or whether the company is going under and whether they will be able to earn a larger salaries over a period. Then also lenders, they assess the likelihood that loans can be repaid. Then suppliers and creditors, they also want to know whether repayments will be made on time. Then customers, they want to assess information to see if the company can continue existence. And then SARS, because they want to tax us. They want to determine our tax liabilities. There are two fundamental qualitative characteristics of financial statements. So that's relevance and faithful representation. So relevance means that information should be useful and should influence the decisions taken by users of accounting information. The information should assist users in evaluating past, present, and future events by, for example, making forecasts of the entity. Then we also have faithful representation. Financial statements should be of actual fact, and they should present the information that it purports to represent. So it should not contain any lies. Then they say financial statements should be complete and include all necessary information needed by the user. Then it should also be neutral, meaning that it is to be set up without any bias or to achieve a predetermined result. And people often try to do this. They decide, we want our profit to be R1,000,000, and then they do whatever needs to be done in order to make sure that the profit is R1,000,000. It should not be done like that, because then the information is not neutral. And then financial statements should be free from error. So this does not mean that there's no inaccuracy, because sometimes we need to use estimates and we don't know the exact amount, but we need to describe the transaction, and the description of this transaction should be free from error. So those are the two qualitative characteristics of financial statements. Then we also have 8 general features. So as you can see, this is also very theory-based, and this must also be studied. So number 1, compliance with IFRS. Financial statements are set up as required by the International Financial Reporting Standards. As I've said before, you cannot do whatever you want. There are certain rules to be followed when we want to set up financial statements. Then going concern. Going concern means that the company will continue to exist in the near future. So this is an assumption made when financial statements are set up. We say that we believe that the company will continue. If not, it must be set up on the liquidation basis. Then the the accrual basis, we must account for 12 months of information. So therefore, we recognize income in advance or expenses payable. We create all those accruals in order to make sure that 12 months of information are represented. Then materiality, items of dissimilar nature are presented separately. So we don't present assets in the statement of comprehensive income together with expenses. No, we need to look at what is the nature of the account and where should it be presented. Then offsetting, we may not take certain or similar information and set it off against one another. They often take net interest, so they take the interest income and they deduct interest expenses to get a net amount. That should not ever be done. Then frequency of reporting, financial statements are published every year. Comparability, we need to disclose the current year as well as the previous year's information. And then consistency of presentation, information is disclosed similarly over time, and that also helps with comparative comparative information to make sure that information can be compared to each other. Then the structure and content. The following is important when we set up financial statements. We need the name of the entity, the name of the financial statement. For example, is it the statement of comprehensive income or is it the statement of financial position? Then also the monetary unit. Is it in rand? Is it presented in dollar or in pound? And then also the level of rounding. So you will see if you look at financial statements, they usually use this, or they can also use 6 zeros to show how the amounts were rounded off. Our first statement is the statement of financial position. I believe that you are familiar with this statement, and it consists of a few sections, 2 asset sections and 2 liability sections, and then also an equity section. So the first one we have is non-current assets, which includes any fixed, intangible or financial assets and also goodwill. So these are any assets that are not classified as current assets. So intangible assets will typically be any asset that you cannot touch. It could be a website, for example, or a patent. Then a fixed asset you are familiar with, those are our vehicles, buildings, etc. Financial assets, those are fixed deposits. And then goodwill, I think you've also become aware of goodwill. Goodwill is when we purchase shares in another company for more than they were actually worth, then we recognize a goodwill account. Then we also have current assets. So for an asset to be a current asset, it must satisfy one of the following criteria. Must be realized within 12 months after the reporting date, intended for sale or consumption, or it's realized in the normal operating cycle. For example, inventory, it is held for trading purposes, or it's cash equivalents, or it's debtors. So that's what current assets consist of. Then we also have our non-current liabilities. Those liabilities that are not classified as current liabilities. These are long-term loans, deferred tax that you don't have to know now, and then also preference shares classified as liabilities. So these are all long-term loans and long-term obligations. We also have current liabilities. They must again satisfy one of the following criteria. They must be settled within 12 months or settled in the normal operating cycle, must be held for trading purposes, and the entity does not have an unconditional right to defer payment for more than 12 months. So then also the equity, that's the difference between an asset and a liability. For example, share capital, retained earnings, general reserves, and there are also other reserves that you can use like asset replacement reserves and so on. Then the statement of profit and loss and other comprehensive income. There are 2 different layouts for this statement. We can use the per nature layout. That is when we start with revenue, then we have other income, changes in inventory, consumables, personnel costs, depreciation and other expenses, finance cost, income tax, other comprehensive income. So here all the different line items are sorted per type or per nature. So here you will see we'll have depreciation separately, we'll have a personnel cost separately. So I don't think we often use this layout, but rather the next one. We often use the one per function, and you should be very much familiar with this one, where we start with revenue less cost of sales provides you with gross profit, then other income, then other expenses, and then finance cost, profit before tax, income tax, profit, and other comprehensive income. This is the one that we usually use, and that's the one per function. Then the statement of changes in equity, you should be familiar with it. It demonstrates the changes in share capitals, any changes in reserves, and also changes in retained earnings. The other statement that we have is the statement of cash flow. But luckily, we will not do that one now. It will be done in detail later in the semester. And that's our statements then. I will see you in class. Our next topic will be PPE. And thank you very much for watching this video. But before we are done, I quickly want to show you, I thought about making it a bit more practical. So I went out and I looked for financial statements just for you to see what it looks like. So I found some financial statements of Pick n Pay. I think we all know Pick n Pay. So just for a bit more of practicality, I just printed out these slides, and these are the Pick n Pay Group financial statements. And this is, for example, what a director's report looks like. So this was for the period for 2014. And as you can see here, they talk about dividends declared, which is very important, and changes in share capital, also going concern, which is one of the features. So they say that it was prepared. The statements were prepared on the basis of going concern. They talk about legal proceedings against the company, any special resolutions that had been taken, directors' fees. So this is what a director's report looks like if we just want to make the class a bit more practical, because I don't think many of the students have ever looked at a set of financial statements. So there's your set. There's the director's report that we talked about. There's also an independent auditor's report, which was also one of the reports that had to be included in financial statements. And here you can see what an auditor's report looks like. And they say here that normally we look at just at the opinion of the auditors, and they say here that in their opinion the financial statements are fair and in all material aspects, and that they believe that it is a fair representation free from any error. So we normally look at that. KPMG was the auditors of Pick n Pay. They talk about what the auditor's responsibility was, and very interesting here is that they say it is Pick n Pay Holdings Limited, RF. That RF stands for ring-fenced. And you don't often see this, but I see Pick n Pay uses the RF at the end of their name, which means that it is ring-fenced and that there are certain, in their memorandum of incorporation, certain articles there may not be edited, which is ring-fenced. They're very interesting. I have not seen it in a long time. Then they also talk about how the directors' responsibilities, what the directors had to do, and that the financial statements are their responsibility. So this is what an auditor's report looks like, if you have never seen it. Then they also have a consolidated statement of financial position. So this is group statements that you haven't done before. But here you can also see the non-current assets, the current assets, their equities, their liabilities, their non-current liabilities, and the current liabilities. So here is their statement of financial position, and it does actually look the way that we constructed. So there's their statement. I see that they've done for the Pick n Pay Stores group and also for the Pick n Pay Holdings group. So there are two different groups for which they have presented a consolidated statement of financial position here. Then their consolidated statement of changes in equity. Here you can also see their share capital, also their treasury shares, retained earnings. Then a foreign currency translation. The students who do international trade should be familiar with this type of reserve that is created for the purpose of hedging, and then they also show their total equity. So there's their statement of changes in equity as at 2 March 2014. Also consolidated, which means that it's for the entire group. Then there's statement of cash flows, also done for the group. As you can see, we will do it later this semester, but you have done statements of cash flow before. Also very interesting for there's cash flows from operating activities, cash generated from operations. There they've added back the dividends paid and they've subtracted the tax paid and disclosed it separately. There's their investing activities, financing activities. So the way we do financial statements is really what it looks like out there in the world, if we make it a bit more practical. Here they also have a consolidated statement of comprehensive income. As you can see, they start with the revenue, then the cost of merchandise sold, which is cost of sales. So here you can see that Pick n Pay uses also the function method that we also use. Their trading expenses, profit before tax, other comprehensive income showed there. And then also at the end, they show their earnings per share, the basic and diluted. So again, it is also done in a format that's quite familiar to us for the group. And then, of course, the notes to the financial statements. There are many, many notes here. I just want to show you, they start with the accounting policy, and for a company like Pick n Pay, of course, they have many, many notes, but they start with the accounting policy and how the basis of preparation and the IFRSs that they have applied. And as you can see, they move on and they talk about all the different measurements that they've used, the estimations that they've used. All the significant accounting policies are included here. The cost of the property, how property, plant and equipment is depreciated. So they also have a comprehensive list of notes. Very interesting here how they show the useful lives of their different types of assets, the buildings and the properties 10 to 20 years, and the vehicles 4 to 5 years, and aircraft 7 to 20 years. They show you here that this is where you will find all the information that we normally apply. They talk about impairments that we will do later. They're intangible assets that we've talked about. So a very comprehensive list of notes here for Pick n Pay. So this was just a bit more information that I've added to the video, just to make it a bit more interesting and a bit more practical, because I think sometimes we do things that we can't really observe. So thank you very much for watching this video, and I will see you in class where we will do a question on the preparation of financial statements, which is IAS 1. Bye-bye.